So, what if achieving financial freedom wasn't about navigating this maze of complex investment strategies?
Right.
What if it was actually about a remarkably simple path? A kind of blueprint hiding in plain sight, but maybe obscured by all the financial noise out there.
Interesting way to put it.
Well, today that's exactly what we're doing, a deep dive into that very idea, a roadmap to a truly rich and free life. And it's drawn from a real cornerstone of personal finance,
Oh.
our source for this journey. We've got excerpts from J.L. Collins' incredibly influential book, The Simple Path to Wealth, Your Roadmap to Financial Independence and a Rich, Free Life.
Ah, Collins. Yes. It's quite remarkable, isn't it? How he takes this topic that feels so huge, so overwhelming for many people investing, financial independence.
Yeah, intimidating even.
Exactly. And he distills it down into principles that are just so clear, so actionable, almost counterintuitive because they are so simple in a world that really pushes complexity. So our mission today really is to pull out those core ideas, understand the wisdom underneath them, and crucially make them immediately useful.
Yeah.
Give you the tools, basically, to start forging your own path.
And the story behind the book itself adds another layer, doesn't it? I mean, J.L. Collins didn't actually set out to write some big financial bestseller.
No, not at all.
He started the whole thing just writing letters, simple, straightforward letters to his daughter, who was a teenager then.
Just trying to pass on what he wished he'd known, right?
Exactly. Things he wished he'd known earlier. And those letters, they kind of took off, became a popular blog.
Right, the blog came first.
And eventually that evolved into this really impactful book. It's just a great example of, a father sharing wisdom,
Yeah.
wanting to empower his kid. And it ends up becoming this roadmap for so many people. Okay, let's really begin.
Let's do it.
So Collins puts down this foundational mantra, like right at the beginning. It's almost a creed. Spend less than you earn, invest the surplus, avoid debt. It sounds, almost too simple, doesn't it? Like something your grandparents would say.
It does. Very straightforward.
But Collins doesn't just say it. He promises, with total conviction, do simply this and you'll wind up rich. And he adds, importantly, not just in money.
Yeah, that's key. He's not just talking about a bank balance.
No, exactly. He's talking about a fundamental shift, right? In how you live, how you think about work, your goals, your whole relationship with the world, really. It seems basic, but it's the bedrock for everything else he talks about. Sets the stage for this deeper kind of freedom.
Yeah, and building right on that, he introduces this concept that's, it's pretty provocative, but also really empowering. FU money.
Right. The famous FU money.
Yeah. And people might wonder, okay, what is that exactly? He actually credits the phrase to James Clavell's novel, Noble House.
Ah, okay.
And he describes it as this tangible name, unforgettable, for a very specific, very personal goal. And it's not necessarily about having enough to just quit forever and live on a beach somewhere.
No, it's more nuanced than that.
It really is.
Yeah.
Its core purpose is about having enough capital, enough reserves that give you the absolute power to just step away from a situation you don't like, or to negotiate from a real position of strength.
Just to say no.
Or just say no, exactly. When a job or a demand or whatever it is just doesn't align with your values. It's the ultimate freedom enabler, fundamentally changing how you relate to your work, your boss. Even your own sense of self-worth, really.
Yeah, it lifts that burden of just having to do something for the money.
Precisely.
Yeah.
It lets you prioritize what actually matters to you over those external pressures.
And he really brings this idea to life with some great personal stories, real examples of this FU money in action. He talks about when he was 25, he'd saved up $5,000, which wasn't nothing back then, especially on his $10,000 salary.
Right, that was significant. Half a year's pay, almost.
Exactly. And he really wanted to travel Europe. So he asks his boss for 4 months of unpaid leave.
Which back then was probably unheard of.
Totally. Request denied, flat out. Work wasn't seen as negotiable like that. But Collins, because he had that $5,000 buffer,
His FU money.
he just calmly resigned. And this is where you see the power, right? The boss, faced with someone actually willing to walk away, immediately backpedaled.
Amazing.
Ended up giving him 6 weeks leave instead. So that $5,000 didn't just pay for a bike trip around Ireland and Wales.
It bought him leverage.
It bought him leverage, negotiation power, and this profound feeling of freedom that he said he instantly knew he never wanted to lose again.
Wow.
And later, he used that accumulated financial strength for even bigger shifts, changing careers, focusing on buying businesses.
And the story about being unemployed after 9/11.
Yes.
Yeah.
That's maybe the most telling one. He was out of work for 3 years, a really uncertain time for everyone.
Yeah, a scary time.
But his finances were so solid because of this principle that when his daughter, who was only 8 then, heard news about the autonomy and asked if they were poor, his answer was just so calm and reassuring. No, we're just fine. We have money that's working for us instead. I mean, that just perfectly sums up the real liberating power of it, doesn't it?
It really does. It's not about being rich in the slashy sense. It's about security and choice,
Mm.
which leads us to the other side of that coin. Debt.
Oh, yeah. Collins does not hold back on debt.
No, he has an almost like visceral reaction to it. He's completely uncompromising. He says, and this image sticks with you, carrying debt is as appealing as being covered with leeches and has much the same effect.
Oof. Yeah, that's memorable.
And he breaks down why it's so bad, going way beyond just the interest payments. First, it just flat out reduces your current lifestyle, right? Because a chunk of every paycheck is already spoken for going to service that debt.
Right. It's gone before you even see it, almost.
Exactly. It essentially enslaves your future income. You're constantly working to pay for past consumption, which drastically limits your ability to make choices now, choices aligned with your actual goals.
And the stress.
Oh, the stress is huge. He talks about that pervasive feeling of being trapped, buried even. And the psychological effects are really insidious things like shame, guilt, feeling alone, helpless.
Like fighting an addiction, he compares it to?
Yes, that's a powerful comparison, because it often is a prison you build yourself,
Yeah.
often through choices that seemed reasonable at the time. And he points out how debt keeps your focus stuck on past mistakes, stuck on present pain, stuck worrying about future disasters. It cripples your ability to think clearly or plan ahead.
And can even lead to, like, self-destructive habits. More spending, even.
Paradoxically, yes. More spending, drinking, smoking, creating this awful feedback loop.
So given how strongly he feels, his advice on getting out of debt is, well, it's pretty counterintuitive. It goes against a lot of common advice.
It really does.
Like, he says point blank, I would not pay a service to help. He thinks they just add cost and don't have any magic tricks you can't do yourself.
Right. No secret formulas.
And he also dismisses consolidating loans. He says, I would not worry about trying to consolidate your loans because the goal isn't just a lower interest rate. It's a zero interest life.
Get rid of it entirely, not just shuffle it around.
Exactly. And maybe the most surprising one he advises against the debt snowball method, paying off small loans first for the psychological win. He says, I would not pay off the smaller loans first for the psychological boost.
That one surprises a lot of people.
So what's the takeaway for you, the listener? Collins basically says you need to change your attitude to fit the cold, hard numbers, not try to bend the strategy to make yourself feel better psychologically.
He calls those other methods crutches.
Yeah, crutches like debt services, consolidation, small wins. He thinks they just delay the inevitable, which is the need for serious discipline and often a pretty dramatic lifestyle change.
Cut spending ruthlessly.
Ruthlessly. Free up every possible dollar and throw it aggressively at the debt, highest interest rate first. It's simple conceptually, he admits, but
Not easy. Not at all.
definitely not easy. It takes real commitment, maybe for months, maybe years. But the upside is, once you ingrain that habit of lower spending and higher saving.
You've built the exact muscle you need for building wealth later on.
Exactly. You've forged the key habit.
And thinking about that bigger picture, Collins really highlights the beauty of a high savings rate. It's got this amazing twofold benefit.
All right.
He says, you learn to live on less, even as you have more to invest. Which is just fundamental, right? It shrinks your future needs while simultaneously turbocharging your ability to save and invest.
Right. You need less and you save more. It works both ways.
Precisely. And it connects directly to this idea that real financial freedom is just as much about managing your needs and wants as it is about just piling up cash.
Which immediately makes you think, how does that square with, well, everything around us? Society, marketing, constantly pushing us to consume more.
Exactly. That's the clash. Collins points out that the lines between need and want aren't just blurry. They are deliberately, skillfully obscured by our consumer culture. It makes it really hard for people to even see financial independence as a real possibility.
He has that funny story with the video camera.
Oh yeah, the friend who bought a new video camera and earnestly said, you know, Jim, you just can't raise a child properly without one of these.
Ah, as if.
And Collins' quiet response was perfect.
Oh.
Billions of kids, he pointed out, were raised just fine without ever being filmed. It just shows how deep that need for more gets programmed into us. Businesses are masters at pushing their needs onto us through persuasion.
And that persuasion, unchecked, is deadly for your wealth.
Absolutely deadly. Which brings us to investing that surplus.
Right. Once you've got the spending down, the debt handled, and you have a surplus, Collins is very clear. The stock market is a powerful wealth-building tool, and you should be investing in it.
No ambiguity there.
None. He's totally convinced about its long-term power. But, almost in the same breath, he hits you with the crucial counterpoint, the warning. But realize the market and the value of your shares will sometimes drop dramatically.
And importantly,
This is absolutely normal and to be expected. He's saying this isn't a flaw, it's a feature.
Yeah.
It's part of the deal you sign up for. You have to understand and accept it.
and you need to understand why you're taking that risk. It comes down to the magic of compounding.
Yeah,
This is really the engine, isn't it?
it is. Explain that snowball analogy he used.
Yeah, it's a great visual.
Yeah.
Imagine a small snowball at the top of a long, snowy hill. As it starts rolling, it picks up more snow, right? It gets bigger.
Sure.
But the magic is, as it gets bigger, its surface area increases, so it starts picking up snow even faster. It accelerates.
Okay.
Soon, that little snowball becomes this huge, powerful force growing exponentially. Financially, your initial money earns interest. That interest gets reinvested, and then that interest starts earning its own interest.
It feeds on itself.
Exactly. It's a self-reinforcing cycle. Your money doesn't just grow additively, it grows exponentially over time. It becomes incredibly powerful. But you need patience. Time is the key ingredient.
And he also talks about the hidden cost of not investing. Right, opportunity costs.
Yes, that's so important. The real cost of spending money now instead of letting it grow. His example of the $20,000 car is stark. If you buy that car, instead of investing the $20K at, say, a conservative 8% return, you've lost about $1,600 in potential earnings in just the first year.
Wow, just year one.
And that's just year one.
Sure.
Over the life of the car, factoring in compounding, the true cost of that purchase in terms of wealth you didn't build is dramatically higher. The $20,000 is gone, plus all the massive future earnings it could have generated.
That really reframes spending decisions. Which leads back to market volatility. He's almost bracingly honest about it.
Oh yeah, brutally honest. He says, flat out, market crashes are to be expected. What happened in 2008 was not something unheard of. He wants you to internalize that these big drops aren't weird events. They're normal, recurring parts of how markets work.
And he lists them off, doesn't he? From his own experience.
He does. It's quite a list, meant to build your resilience.
Yeah.
74, 75 recession, the crazy inflation in the late 70s, early 80s. Remember, 20% mortgages.
Unbelievable.
That 1979 business we cover, the death of equities, Black Monday in 87, the early 90s recession, the tech crash, 9/11, and then, 2008.
So after running through that horror show, what's his point?
His point is incredibly reassuring, actually. Despite all that chaos, all those terrifying moments, the market always comes back. Always.
Always.
That's his core message. His ultimate perspective is basically, look, if the market doesn't recover someday, we've got much bigger problems than our investment portfolios. Society itself is collapsing.
Right, then none of this matters anyway.
Exactly. So assuming that doesn't happen, the historical pattern is clear. It recovers. His advice. Toughen up and let it ride.
Okay, so if the market generally goes up long term, why do so many people actually lose money investing?
The million-dollar question. And Collins says the answer is mostly psychological. It's about human nature, our biases.
Like what? What are the traps?
He points out a few big ones. First, this incredibly common but almost always wrong belief that you can beat the market index consistently. He says, look, maybe Buffett can, but for 99.9% of us, it's a fool's game, leads to underperformance.
Okay, don't try to be a stock-picking genius.
Exactly. Second, thinking you can pick the winning mutual fund managers. The data is just brutal here. Simple index funds beat something like 82% to 99% of active managers over 15, 30 years. The odds are overwhelmingly against picking winners consistently.
So don't try to pick managers either.
Right. And third, just getting sucked into the financial media noise, that constant stream of drama, fear, predictions.
The stuff that grabs headlines.
Precisely. It sells ads, but it's terrible for your investing health.
Yeah.
He uses that great beer analogy.
Oh, yeah, tell that one.
He says, imagine pouring a beer. Pour it carefully, get mostly liquid, the beer and a little foam. Pour it too fast, straight down the middle, you get mostly useless foam.
Okay.
The market, he says, is two things. Beer is the real underlying growth of businesses, the actual wealth creation. Foam is all the distracting daily price swings, the media hype, the pundit predictions, the urge to do something.
Oh, those people?
Most people get caught up chasing the foam. reacting to the noise, buying high, selling low, and they miss out on the actual beer, the long-term growth.
That's a great analogy. But he does address the really scary one, right? The big ugly event.
He does. He confronts 1929 and the Great Depression head-on. No sugarcoating. Stocks crashed 90%, took 26 years to fully recover if you bought at the very peak. It's the ultimate nightmare scenario.
The one everyone fears.
Absolutely. But interestingly, he finds some encouragement in the 2008 crisis. He notes that we got right to the edge of that kind of abyss, but didn't fall over.
The system held, basically.
The modern system showed a resilience, however flawed, that prevented a total 1929-style collapse. So his point is, yes, crashes are terrifying, but history suggests even the worst ones are part of a bigger upward trend. It provides context.
Okay. And he also touches on those big macro risks, right? Deflation and hyperinflation.
Yes, the two big wealth destroyers. Deflation, like in 1929, where prices spiral down, crushing the economy. Hyperinflation, like Zimbabwe or Weimar Germany, where prices explode, making money worthless.
Scary stuff. How do you hedge against those?
Well, he explains that stocks tend to be a pretty good inflation hedge. Because businesses own real assets, make real products, their value tends to rise along with inflation.
Makes sense. What about deflation?
That's where bonds come in. Bonds are more of a deflation hedge. If prices are falling, the fixed amount of money that the bond pays you back later is actually worth more in purchasing power.
Ah, okay, so they balance each other out.
Exactly. They act as complementary shields against different kinds of economic storms. It's about building a portfolio that's resilient across different scenarios.
Which leads us perfectly into his core investing philosophy, which boils down to one word, really.
Simplicity.
Simplicity. He just hammers this home. Simple is good. Simple is easier. Simple is more profitable.
And his reasoning is compelling. Complex investments, he argues, mainly benefit the people selling them, not you.
Right. The more layers, the more fees, the less likely it is to be good for the actual investor.
It's usually designed to extract wealth, not build it for you.
So it's simple as the goal. Who embodies that? This brings us to Jack Bogle and Vanguard.
Absolutely central to Collins' approach. You have to understand Vanguard's structure. Bogle set it up back in '75 to be client-owned, operated at cost.
Unique in the industry.
Totally unique. It means Vanguard's interests and your interests as an investor are perfectly aligned. There's no conflict. Other firms serve company owners and investors, sometimes pulling in different directions.
But Vanguard's profits just go back to investors.
Effectively, yes. Through consistently lower fees. That's the model. And Bogle's big idea, indexing, just buying the whole market, was laughed at initially.
Wall Street hated it.
Hated it because it threatened the high fees they charge for active management, which Bogle showed didn't usually work anyway. But decades of data have proven him right again and again.
And the paradox is?
The paradox is, by accepting average market returns with an index fund, you actually guarantee you'll be in the top tier of performers because you're beating most of the high-fee active funds.
Okay, so accept average, end up above average. Got it. What's the specific tool he recommends then?
His go-to is VTSAX, the Vanguard Total Stock Market Index Fund.
What exactly is that?
It mirrors the entire U.S. stock market. So it holds a tiny piece of basically every publicly traded U.S. company. We're talking like 3,700 companies.
Wow, everything from Apple down to the smallest guy.
Pretty much everything. This, Collins says, is the one basket you should put all your eggs in, especially early on. And then...
Forget about it.
Forget about it. That's his famous line. He points out the irony. The more you obsess, the more you watch and tinker.
The worse you probably do.
The less well you're likely to do.
Yeah.
VTSAX gives you huge diversification, super low costs, it's efficient.
Yeah.
And it demands almost none of your time or attention.
And if you don't have the minimum for VTSAX...
There are other versions, like VTSMX Investor Shares or the VTI ETF. They hold the exact same stocks, just structured slightly differently, making it accessible to pretty much everyone.
Okay, so you've got your VTSAX, but how do you adjust things as life changes?
Yeah.
Asset allocation, but he frames it differently, right? Not just by age.
Exactly. He talks about life stages, not just your age, which makes so much more sense because your stage is not necessarily linked to your age.
Right. Someone might retire early or take a career break.
Or start a business or go back to work. Life isn't linear. So he identifies two main stages. First, wealth accumulation. That's when you're working, saving, adding money to your investments.
Building it up.
Building it up. Second, wealth preservation. That's when your earned income slows down or stops, and your investments need to start paying you an income.
Living off the portfolio.
Right. And this stage-based approach means your strategy should be flexible shifting with your actual circumstances, not just a birthday.
Okay, so for that first stage, wealth accumulation,
Yeah.
what's the strategy, especially for someone young, aggressive, really aiming for that FU money fast?
His advice here is bold. Really bold, he says. 100% stocks, specifically 100% VTSAX.
Wow, 100%. No bonds, nothing else.
Nope. His philosophy is put all your eggs in one basket and forget about it. He actively dismisses typical diversification advice for this stage. Screw that. He says, you're young, aggressive, and here to build wealth.
Okay, that's pretty direct.
His rationale is focus entirely on the best long-term growth engine, stocks.
Yeah.
Mentally prepare for the bumps and just ride it out. And the example he gives is incredible.
The $200 a month one.
Yeah. Just $200 a month, $2,400 a year, invested consistently in the S&P 500 from 1975 to 2015, despite all those crashes and recessions we listed.
It grew to
Over $1.5 million.
That's staggering. From $200 a month.
It shows the sheer power of consistent, simple, long-term investing. Patience is everything.
Okay, but eventually you might want less volatility, or you hit that wealth preservation stage. That's where bonds come in, VBTLX.
Exactly. VBTLX, the Vanguard Total Bond Market Index Fund. That's for the preservation stage, or just for anyone who wants a smoother ride along the way.
And bonds are basically loans.
Yeah, simple definition. When you buy bonds, you are loaning money to a company or government agency. You're not owning a piece of the business like with stocks, you're lending money. They're the steady cousins to stocks.
Less exciting maybe, but more stable.
Generally, yes.
Yeah.
They have their own risks, but they're crucial for diversification. They act as that deflation hedge we talked about. Stocks like inflation, bonds do better relatively in deflation.
And they smooth out the portfolio's overall bumps.
Significantly. Less volatile. Plus, they provide a steady income stream through interest payments. And crucially, holding them in a total bond market fund like VBTLX diversifies away most of the risks of holding individual bonds, like a specific company defaulting.
Or interest rates suddenly changing.
Right. The fund holds thousands of bonds with different maturities, different issuers, which buffers against those specific risks. You get the stability without the individual bond headaches.
Okay, makes sense. Now, what about getting the money in? He has strong opinions on dollar cost averaging, DCA. Most people recommend it.
But Collins is not a fan. Emphatically not.
Remind us what DCA is again.
It's investing a fixed amount regularly, like $500 every month, no matter what the market's doing. The theory is you average out your purchase price, buy more shares low, fewer highs.
This sounds logical. Why doesn't he like it?
His main argument is statistical. Historically, the market goes up much more often than it goes down. About 77% of the time, he says.
Okay.
So if the market is generally rising, and you're dripping money in slowly via DCA, you're consistently buying fewer shares at higher prices than if you'd invested it all at once. You're basically sparing yourself some gain, as he puts it, missing out on upside.
And it messes with your allocation.
Yeah, he says it screws with your asset allocation because you've got cash sitting on the sidelines, earning next to nothing, waiting to be invested instead of being fully deployed according to your plan.
So he sees it as a form of market timing.
Essentially, yes. Which he calls a loser's game. He thinks DCA is about adjusting your behavior to soothe your fear of investing a lump sum rather than toughening up your mindset to accept the market's nature. It feels safer, but it likely costs you returns long term.
Interesting perspective. It definitely challenges the common wisdom. Which brings us back to advisors. If the path is so simple, why do people still rely on traditional advisors and gurus?
Yeah, it's a critical question. Collins is incredibly skeptical here. He has that famous line about good ethical advisors being rarer than baptized rattlesnakes.
Huh. Okay, so he's not a fan of them either.
Not generally. His core issue is the fundamental conflict of interest. Advisors often make more money selling complex, high-fee products than recommending simple, low-cost solutions like index funds.
What's best for the client isn't always best for the advisor's wallet.
Exactly. That inherent conflict, he believes, leads to a lot of well-intentioned but bad advice. He warns specifically about things like commissions or loads, high ongoing AUM fees, and churning unnecessary trading just to generate fees.
So why do people fall for it?
He suggests it's often because people are chasing quick wins, the thrill of beating the market, wanting bragging rights. They prefer excitement, even if it's illusory, over the quiet, steady, boring path of indexing.
And they don't see the fees eating away at their returns.
They often don't realize how much those seemingly small fees compound and drain their wealth over time. It's insidious.
Okay, let's shift gears a bit. He talks about something darker to con artists, and the idea that there's no such thing as a free lunch.
Yeah, this is a really important, if unsettling, section. That story about his friend's wife.
The one who said, I can't be conned.
Exactly. And Collins immediately tells her, with that, you've just violated the first rule of not being conned. His point is, the moment you think you're immune, you become vulnerable.
So what are his rules for not being conned?
First, accept that you can be conned. Anyone can. Intelligence doesn't make you immune. Second, understand cons don't look like cons. Con artists are charming, legitimate seeming, trustworthy, not shady.
They have to be, right?
Absolutely. Third, and this is subtle, 99% of what they say might actually be true. The lie, the hook is buried deep in the fine print, hidden in a mountain of believable stuff.
Okay.
And finally, the golden rule. If it looks too good to be true, it absolutely is. No exceptions in finance, no free lunches.
Then he gives that example of the Mr. Hasn't Missed One Yet dinner scam.
Yeah, the slick guru, maybe an author, hosting a fancy free dinner, sharing exclusive insights, offering a few slots for special investors.
It sounds plausible.
Totally plausible. But if you don't spot the hidden lie in that too good to be true setup, he says, you will get conned eventually because you haven't learned the basic rules of protecting yourself.
Okay, sobering stuff. Let's move to the other end of the journey getting the money out, the withdrawal phase. He talks about the 4% rule.
Yes, the famous 4% rule based on the Trinity study. The idea is you withdraw 4% of your portfolio in the first year of retirement, then adjust that amount for inflation each year after. Historically, with a typical stock bond mix that had a very high success rate, like 96% over 30 years, the portfolio usually lasted.
But what about the 4% where it didn't last? That's the scary part.
Right. And Collins addresses that directly. He stresses that the real key isn't rigid adherence to 4%, but sensible flexibility.
Meaning?
Meaning, if the market tanks badly early in your retirement, you need to be willing to tighten your belt, cut back on withdrawals and spending temporarily until things recover. That adaptability, that flexibility is what really provides the security more than the fixed rule itself. It stops you from selling assets when they're down.
Okay, so the rule is a guideline, but flexibility is crucial. How do you actually take the money out? He talks about different buckets, right?
Yeah, this is super important. He emphasizes that things like 401ks, IRAs, Roths, HSAs, they aren't investments themselves. They're just the containers, the buckets that hold your investments, like VTSAX.
Got it. Tax-advantaged containers.
Exactly. And the withdrawal strategy is about pulling from these buckets in a specific order to minimize taxes over your lifetime.
What's the typical order?
Generally, you'd start with contributions you made to Roth accounts because those come out tax and penalty free. Then you'd move to your regular taxable accounts holding things like VTSAX.
Okay.
And finally, you tap into your traditional IRAs and 401k, especially once required minimum distributions or RMDs kick in.
Ah, RMDs. The government forcing you to take money out so they can tax it?
Pretty much. They start at age 70 and a half currently, though that age might shift. So following that sequence is designed to be tax efficient and help your money last longer.
You mentioned HSAs, health savings accounts in there. He seems to think those are particularly powerful.
Oh, incredibly powerful. He highlights their triple tax advantage, which is pretty unique.
Triple advantage. How?
Okay, 1. Contributions are tax deductible, often pre-tax right from your paycheck, saving you income tax and sometimes payroll taxes too. 2. The money inside the HSA grows completely tax-free. No taxes on interest, dividends, or capital gains year to year.
Okay. Tax deductible in, tax-free growth. What's 3?
3. Withdrawals are also tax-free, as long as they're used for qualified medical expenses.
Ah, okay. So tax-free in, tax-free growth, tax-free out for medical.
Exactly. But here's the kicker, what makes it so flexible. Unlike FSAs, there's no use it or lose it. The money rolls over year after year. You can build up a substantial balance.
So it becomes like a retirement account.
It absolutely can. You can use it for medical costs anytime, now or in retirement, when costs are often higher. Or, and this is key, after age 65, you can withdraw the money for any reason without penalty.
Yeah.
You just pay regular income tax on non-medical withdrawals then, like a traditional IRA.
Wow, that is flexible. Medical fund or extra retirement fund?
It offers amazing options, a really potent savings tool.
Okay. What about Social Security? Does Collins think we can rely on that?
He's refreshingly honest here. He admits he Personally, never planned on it being there for him, built his own plan, assuming zero.
A conservative approach.
Very. But as he got closer to retirement age, he became more confident in its survival, largely thanks to the political power of older voters in groups like AARP.
They vote.
They vote. So for listeners 55 and older, he thinks you'll get every dime promised. It's just too politically risky to cut benefits for current or near retirees.
But for younger folks?
For those under 55, he says, expect the deal to be a lot less sweet. Think smaller benefits than currently projected, higher costs to fund it, like maybe raising the income cap for taxes, pushing the retirement age further out.
And maybe means testing.
Yeah, that's a real possibility. Benefits potentially reduced based on your other income or assets, not just what you paid in. So for fiscally responsible people who save well, like our listeners hopefully, it's probably not going to feel like a great deal compared to investing that money yourself.
But he still sees its value for society.
Absolutely. He acknowledges it provides a vital safety net, keeping millions of people out of abject poverty, preventing them from, as he puts it, living on cat food. It serves a crucial societal purpose, even if it's not the best personal investment for diligent savers.
Right. Now, towards the end, he talks about something really interesting, charitable giving, and how it relates to pleasure.
Yes, this is fascinating. He says quite powerfully that the money that gave him the most pure personal pleasure wasn't buying something fancy for himself, but spending $1,200 on a really nice gourmet dinner for his daughter's school teachers just to say thank you.
Wow. That says a lot.
It really does. It shows that for him, wealth's ultimate purpose isn't just accumulation, it's the satisfaction and meaning you get from giving back effectively. His approach is very practical, too.
How so?
He suggests concentrating your donations on just a couple of charities you really care about and have vetted.
Yeah.
He advises against giving over the phone, as those solicitations often come from less efficient groups. And he stresses using tools like Charity Navigator to check how efficiently a charity uses its funds.
Making sure the money actually does good.
Exactly.
Yeah.
Which raises that question. How does financial freedom actually enable this kind of thoughtful generosity?
Yeah.
Well, obviously it provides the money itself. But just as importantly, it frees up your mental energy. You're not constantly stressed about your own finances, so you have the bandwidth to actually research, think strategically, and engage with philanthropy in a way that maximizes its impact and ultimately your own satisfaction from it.
Transforms it from an obligation to a joy, maybe.
That seems to be his experience.
And he even set up his own charitable fund, right? Through Vanguard.
Yes, the J.J. Collins Charitable Fund using the Vanguard Charitable Endowment Program. And he points out this isn't just for the super rich. You can start a donor-advised fund like this with around $25,000.
Okay, accessible. What are the benefits?
Several big ones. You get an immediate tax deduction the year you contribute the money. You can donate appreciated assets like stocks that have gone way up directly to the fund without paying capital gains tax on the growth. That's huge.
A double tax win, he calls it.
It's exactly. Deduction for the value, no tax on the gains. You can even roll RMDs from your IRA directly into it. And you maintain control. You decide which charities get grants from the fund, when and how much, all with Vanguard's low costs. It's a really efficient way to manage your giving.
Very smart. So wrapping things up, how does he connect all this practical financial advice back to a bigger picture, a philosophy of life?
He uses that wonderful story about Mook, the guy he met who basically on a whim bought a pineapple plantation in Tahiti in the 60s with zero farming experience.
Which failed, right?
Predictably failed. But then a local bank, liking their spirit, offered them a half-built hotel. They finished it, Mook figured it out, ended up owning multiple hotels, lived this incredibly free life, literally barefoot, still going strong at 80.
Amazing story. What's the point?
The point is a reminder that seeking absolute security is futile. It simply doesn't exist, Collins quotes Mook as saying. You can't know for sure the economy won't tank or the 4% rule won't fail in some future scenario. Forget asteroid impacts or zombies. Those are out of our hands. But we do face risks.
Financial risks, life risks.
Exactly. And this leads Collins to his final profound question for us, for you, the listener. If you can't eliminate risk, and catastrophic events are unlikely or uncontrollable, and daily risks can be managed using these principles, what's the real risk you're facing?
Which brings us to that final thought. You don't actually get to choose not to have risk in your life. You only get to choose what kind of risk you're willing to take on.
That's the fundamental choice.
So as you think about everything we've discussed today, maybe ask yourself, What risk are you choosing right now in your financial life? And does that choice truly align with the kind of freedom, the security, the rich life in every sense that you're actually seeking?
A powerful question to ponder.
We really encourage you to take these ideas from J.L. Collins. Simple, yes, but incredibly powerful. And think about how you can apply them. Start building that path to a life with more choice, more purpose, and hopefully a lot less financial anxiety.